But we have, about 15 days left for the union budget. What are the expectations from key sectors? And we're going to focus on the banking sector now. In the quarter gone by, some of the banks like Bank of Baroda had reported an improvement in terms of retail loan growth. And there's a bit of a pickup in the corporate capex cycle as well. We have the management, Sanjiv Chadha, the MD and CEO of Bank of Baroda, joining us now to discuss their business outlook. Mr. Chadha, good morning. Happy New Year to you, and thank you for speaking to CNBC TV18. At the onset, let's begin by just setting a bit of a context for the interview. How are you looking at loan growth at the moment? You have seen a pickup in retail loan growth in the quarter gone by. Now corporate growth is also picking up. But where do we stand as of now, and what do you see as the overall loan growth by the end of the year?
Very good morning, Sonia, and a very good morning to all of your viewers, and a very happy New Year. So as far as loan growth is concerned, I think we are seeing the consolidation of a trend that we have seen over the last few quarters. Loan growth is picking up from what has been a pretty tepid pace for pretty much the last 3 or 4 quarters. And I would believe that by the end of this year, we might end up with somewhere very near double-digit loan growth for the industry, maybe between 8 to 10%. And there is scope for further consolidating that gain as we go into the next year. It is, of course, also a fact that a significant proportion of the loan growth has come from sectors which have benefited from specific government interventions. And when it comes to the private investment cycle, it is something which is, again, not an undifferentiated positive picture. There are some sectors where we are seeing significant investment, and in others, it is still to pick up. So again, in terms of a broad picture, I would say it's an improving picture and an improvement which is likely to sustain into the next year.
Mr. Chadha, hi, good morning. Could you give us some numbers, sir? What will that growth that you're talking about look like? What is the trend rate of growth in the segment, corporate lending going to be like? And where exactly, what kind of demand for credit are you seeing? Is it working capital needs? Is it fresh capex, term loans? Some idea, sir.
Yeah. So I think first force is that over the last few quarters, we have seen that the retail segment growth has been faster than the corporate segment. I think that is still likely to continue for a little more time. So particularly, again, when it comes to areas like car loans, for instance, they have been a very robust story for us with growth which has been more than 20% YOY for a few quarters now. That's something which we expect to continue into the next year also. And this is despite the challenges we have seen in terms of supply because of the semiconductor issues. Similarly, loan growth has picked up. There were, again, incentives which came in from various states in terms of stamp duty. So I think the offtake of home loans, particularly in large metro markets and also in the broader category, has been very good. I think across the industry, gold loans has been an area which again has seen very good growth, both in terms of the gold loan companies as well as in terms of the banks. So the retail growth has been good, likely to continue. When it comes to the corporate loan growth, it has been either in state companies which have borrowed more, particularly state government enterprises, and also in sectors which, as I mentioned, which have been supported by specific government interventions. For instance, again, in the road sector, we have seen a very robust offtake, and this has been supported by the initiatives of the NHAI, the Golden Quadrilateral. Similarly, in renewable energy, right across the value chain, we have seen very good demand, including, again, going down to e-vehicles, as well as, again, entities which are now encouraging retail consumers to pick up e-vehicles. So that's something which has been very good. And then there have been second-order effects in terms of cement, steel, where we have seen a large amount of investment coming in, particularly by way of brownfield expansion projects. I think the difference, again, in the corporate loan growth has been that it is not indiscriminate, where you have started everybody looking at investing in the sector. It is the larger players, the players who have the resilience as well as the liquidity, and also, again, significant market share, which is where you're seeing a lot of investment coming in.
And in terms of wanting to fund that kind of demand, what is competition like, and where does Bank of Baroda fit there?
So I think the
competition and willingness, of course, also. Yeah.
Yeah. So I think willingness is not a challenge at all. The banks are flush with liquidity. They are looking at opportunities to grow their book. So in fact, the competition is very, very stiff, particularly when it comes to the well-rated corporates. As I mentioned, most of the investments are coming in from the larger corporates, and these corporates can demand very, very keen pricing. So I don't believe that there's any challenge at all in terms of the intent to lend. I think it is simply that the opportunities are still concentrated, not broad-based enough, and therefore there's still a pressure on pricing, and this pressure on pricing is likely to continue. Of course, it's a good thing for people who are looking to make investments.
Okay, that's good to hear. The good part is, despite a severe COVID crisis, the stress in large banks has been contained quite a bit. Assuming there's no major third wave, do you think overall the banking system can normalize credit costs by the end of the year and bring down NPAs further?
I believe your assessment is on the spot. There has been a benign credit cycle which has been gathering pace over the last 1.5 years. Credit costs have been coming down steadily, even through the first wave, the second wave, and now, of course, Omicron. If you see again what the prognosis, all of us might have been at the beginning of COVID, the fact that gross NPAs might increase, we have seen that gross NPAs actually have come down. I think they have come down for us sequentially quarter on quarter. Also, profitability has improved significantly because of credit costs coming down, and therefore the capacity of banks to provision even historical losses has been much superior, and therefore net NPAs have been coming down. And I think your assessment that we might, within the next 12-month period, see the normalization of credit costs, I think is a very fair assessment. And we should see this trend of credit costs coming down actually become more pronounced in the coming quarters.
So particularly for Bank of Baroda, how much have the credit costs come down by, say, up until now? And what is the expectation by the end of the year?
So our credit costs again had moved well above 2% over the last few years. And we had guided that this year we expect credit costs to be below 2%. And this is despite the second wave. So credit costs are going to be lower as compared to the previous years. They are likely to be well below 2%. And we expect that this improvement, as I mentioned, is likely to continue into the new financial year.
What about net interest margins, Mr. Chadha? What's going to be the trajectory there?
So I think margins is a mixed story. On the asset side, there has been pressure on the yields. As I mentioned, because of the ability of corporates to command a very good pricing on the one hand. On the other hand, there was also a secular trend in terms of lowering of rates, which meant even the rates on home loans, car loans have come down appreciably over the last 2 years, which of course has helped sustain demand. But on the other hand, there has been a countervailing impact on the liability side. And we have tried to be very disciplined in terms of liability growth, making sure that both the loan growth and the deposit growth are in tandem. Our CD ratio has been pretty much steady over the last 1.5, 2 years. And therefore, the impact of the liquidity overhang, which characterizes the market, has been limited in our case. Therefore, even while there has been pressure on yields, we have been able to protect our margins. Even last year, our margins again had been steady to improving. And we expect this year also our net interest margins to possibly move up by 10 bips or so.
Sure. Sorry, we're running out of time. I just wanted to squeeze in one last question. Since we're heading into the union budget, what is your key ask from the industry standpoint? And also, what do you think the government can do to sort of boost growth in the MSME, in the unsecured credit space, where there has been a fair amount of stress?
So I think the biggest thing that the government might want to do is to make sure that the recovery that we have seen, that is fully supported by way of the elevated levels of government expenditure that we have seen, because the private sector cycle is still in the process of being revived. The contribution of the government to gross capital formation over the last year or two has been significantly higher as compared to trend lines. We would expect that to continue to some extent during this year also, even as the private sector investment cycle picks up. So that's one. Number two, while there has been a broad-based recovery, large corporates are doing very well. There are some sectors which are still vulnerable, the MSMEs, as you mentioned, and there the government's intervention by way of the ECLGS scheme has been eminently successful. So I believe we should build on that success. While the Omicron wave will not be impacting the large corporates significantly, the MSMEs, which were actually just about recovering, have been set back a little bit. So I think continuation of that support is also very important. So I think these are two key things that we would look at. One is supporting the broader recovery by way of high expenditure, and number two, selective interventions for sectors which might still be vulnerable, even though there's a broad-based recovery underway.
Got it. Thank you very much, Mr. Chadha. Appreciate you joining in with those comments. As always, it's a pleasure hosting you here on CNBC TV18. Look at the market and the